Hi, everybody. Thank you all for joining us today for our webinar on maximizing tax strategies combining a 1031 exchange and a real estate IRA. My name is Brenda. I will be presenting today along with Teresa Noer. Teresa is a CES here, her certified exchange specialist. She also does our 1031 exchanges, and I am in our marketing department and will be focusing on the self-directed IRAs. So just a little bit about Midland. So we have two strategies that we focus on to save investors taxes. The first one is self-directed IRAs. So we are self-directed IRA administrators. We've been in business as an IRA administrator for over 20 years now. We are also 1031 exchange qualified intermediaries, also in business for over 20 years. We have two certified exchange specialists on staff, one being Teresa. We are bonded and insured, and we are not tax advisors. We do not give investment advice. We are not CPAs. So any tax related questions, we're going to have to ask you to send those to your tax advisors. We do have offices here in Fort Myers, Florida. Teresa's in our Chicago office, and then we have an office in Sioux Falls, which is where our trust company is located. And just before we get started, please remember that if you do have any questions, to type them into the questions tab to the right of your screen. We'll do our best to get to all of the questions during this webinar. And if there are any specific questions to your scenario or your situation, we might have to take these offline. So just keep that in mind. All right, so Teresa, do you want to tell us why we are all here today?
Yeah, well, I mean, 1031 exchanges and real estate IRAs are exciting enough, but we thought it might be interesting to share with everybody when you could possibly combine the two strategies together. A lot of times we talk about 1031 exchanges or we talk about real estate IRAs, but we rarely ever put the two together and show you how you can utilize them together. So today we're just going to do a very quick review of the basics of 1031 exchanges and buying real estate in an IRA. I imagine most people on this call are familiar with either strategy or possibly both, but just to get everyone on the same page, we're just going to do a very quick review of those things. And then we're going to discuss and show you how you can combine the two strategies and what that process would look like in terms of transaction processing. And then we're just going to discuss some rules to be mindful of when combining the two. So real quick, I just want to give a quick shout out. I see Rick Sass asked a very important question of what am I doing in Chi-Town? So I lived in Florida for over 30 years and transferred to Chicago in 2018 because I just couldn't take the heat anymore. So I needed to see the seasons change, and I certainly got more than what I bargained for, but I love it. Don't hold it against me that I left Florida to go to a colder climate. Moving along. So let's talk real quick about the rules of 1031 exchanges. So those of you that have sat in on previous presentations, spoiler alert, you know the details. Those of you that are not familiar with exchanges, I'm going to give you the Cliff's Notes version right now. So 1031 is a section of the tax code that basically says if you're selling investment or business use property and you buy more investment or business use property of equal or greater value, you're going to get to defer the taxes that would have applied to the transaction, such as capital gains, depreciation, recapture. Usually it'll defer those state taxes if they were to apply, and that net investment income tax, that 3.8% tax. So a 1031 affords a taxpayer the opportunity to put basically all of that money that would have been paid towards taxes towards a new investment property. Now, a 1031 exchange, though, requires some additional preparation. It's not just a matter of selling a property and buying another property. You do have to have a qualified intermediary in place, which is what we do, in order to facilitate the exchange. And you do have to have that in place prior to closing on the sale. In order to defer all the taxes, you have to buy property that is at least equal to or greater than what's known as the net selling price of the relinquished property. All that is the contract sales price minus your standard cost of closing, such as realtor commissions, title fees, the exchange fee. Those are items that can be subtracted from the contract sales price to get you a more specific number of what you need to spend on your next purchase, or perhaps purchases if you're deciding to buy more than one replacement property. The goal is to match value for value. So if your net selling price is, say, $500,000, then you want to buy property that is approximately $500,000 or greater in order to defer those taxes. You can certainly buy for less, which we often have clients do. Thing to remember is that if you purchase for less than your net selling price, you may have some tax liability on the difference in value between that net selling price and what you ultimately purchase your new property for. The last two rules have to do with the deadlines involved. You unfortunately do not have an indefinite amount of time to complete the exchange. So you have to complete the exchange within 180 days of closing on the sale of your current property, your existing property, known as the relinquished property. It's 180 calendar days. You must close on all intended purchases within that time frame. Easy enough, 6 months, right? So the second deadline, though, is a little more of a tighter timeline. You have 45 days from closing on the sale of your relinquished property to identify what you are considering purchasing as your new replacement property. So that's where, I'll be honest, it gets a little tricky, particularly in this current market for people. 45 days is going to come and go pretty quickly. So it's important that if you are considering an exchange, you keep that in mind. Once you're under contract to sell your current property, be looking for that replacement property if you haven't already done so. Nothing says that you can't go under contract for the new purchase before that 45 days is up. You could even close within that 45-day period if you wanted to. Just keep in mind that once you get past day 45, only what's identified as of the 45th day will qualify. So once you get past that 45th day, you can't make any changes or substitutions to your list of identifications. So it's go time in 45 days. So, the further along you can get in the process, the better. That's really the main gist of what we try to make sure people understand when they're considering a 1031 exchange, whether it be a real estate professional, whether it be a prospective client. These are the core rules that we always want to make sure people know and understand before entering into it. And so now I'm going to pass it over to Brenda, and she can talk to you about real estate IRAs.
All right. Thank you, Teresa. Okay, so a self-directed IRA is not a special type of IRA. It's just like any other IRA, aside from the fact that you can invest in alternative assets, such as real estate. So most IRA administrators only allow you to hold stocks and bonds in their retirement account. But here you can invest in pretty much anything aside from publicly traded stocks and bonds. Unlimited choices. The two things you cannot invest in are stocks, are life insurance and collectibles. Most contributions are tax deductible. So that is a major benefit. And a lot of IRAs are funded by old 401ks. And it's a good way to diversify your retirement portfolio. So you're allowed to have multiple retirement accounts. You can keep your IRA open and invested in stocks and bonds at Charles Schwab or Fidelity. And you can also have an IRA open with us to buy real estate tax-free. So all types of real estate qualifies to be invested inside of a self-directed IRA as long as it's for investment use only. So that includes single family homes, multifamily, condos, apartments, raw land, even commercial property. So pretty much as long as it's for investment use, you can buy that piece of property using retirement funds. And a huge benefit to that is all of the rental income and the sale proceeds goes back into the retirement account tax-free. So that is great. Also, IRAs are like an alternative source of funds for you or even your clients. If you're a realtor, for example. So if you're looking to buy a piece of real estate and you don't have enough money inside of your personal account, you might have money inside of your retirement account that you can use to partner with yourself personally to make a purchase. So, here are just a few important rules to keep in mind when buying real estate using your retirement funds. And the first one is the title to assets. So, this is how we make sure things are all titled properly inside of the IRA. So, the title would be Midland Trust Company as custodian for benefit of your name and your IRA number. If there's percent ownership, say you own 50% personally and 50% in the IRA, it would be put that way on the contract to show percent ownership. Like I said, this is for investment use only. So, no personal use. It's not your secondary home. You can't vacation in it. It's truly for investment use only. Um, Also, all income and expenses has to go in and out of the IRA when your IRA owns property. So that's any HOA fees, your property tax bill for the year. Those all have to be paid for using IRA funds. And then same with the income going back in, like your rental income, your sale proceeds from the property all go back into the IRA. That's how we keep things all tax sheltered. As soon as you take that money out personally, that's when you may be taxed on it, depending on your account type. So, another thing to keep in mind is no prohibited parties are allowed to do business with your retirement account. So, these are a list of prohibited parties. So, you yourself is a prohibited party. So, I get the question a lot, oh, I already own a piece of real estate. Personally, can I take that real estate and move it into my retirement account? It's for investment use. Unfortunately, the answer would be no, because you yourself are prohibited from doing business with your retirement account. So when I say prohibited, that means that you cannot, any of these people on this list, all of your lineal ascendants and descendants, yourself, your spouse, your parents, your grandparents, your children, their spouses, and your grandchildren and their spouses, they cannot rent the property from you, buy the property from you, and you cannot sell the property to them. So you need to keep that in mind. No business doing business with these people unless you're going to partner with them. So you can partner with these individuals to do a brand new transaction. They just can't live in the property, you can't buy the property from them, and you can't sell the property from them. All right, Teresa, do you want to give a little example of when they might want to
Yeah.
combine these
Okay.
scenarios?
Sure. So thank you, Brenda. So a lot of times when I'm working with exchange clients, they're usually looking to buy up in value in their replacement properties. And so one scenario that comes up quite a bit is a taxpayer is completing an exchange for a property that was sold for example, $250,000. And let's say they identify a new replacement property that's about $500,000, but they don't want to take on any more debt or any new debt for the purchase. So this is typically when they would ask the question of, hey, is there some other vehicle that I could use, or is there something else I could do so that I don't have to go and get traditional financing? So they could, if they had the funds in an IRA to do so, partner up with a self-directed IRA, whether it be theirs or someone else's, to make the purchase. So Brenda, if you can go to the next one. So how does it work? So I'm gonna kind of break it down for you in terms of the 1031 exchange first, and then how the IRA would play in. So first off, with the 1031 exchange, the objective, remember, is to defer the taxes from that transaction. So if the taxpayer is selling for $250,000 and they want to do the exchange, they need to buy at least $250,000 worth of property to equalize the exchange and defer all the taxes. Okay. So in this scenario, let's say this taxpayer is going to partner up with his own IRA. And so he would identify 50% interest in the new purchase on behalf of the 1031 exchange. So he would literally, when he provides us with his replacement property identification, he will list the property, the total purchase price, but then specify that 50% of the total value is being identified for the exchange. And that leaves the remaining 50% interest to be acquired by the IRA or another partner or buyer, I should say. And so in this instance, it's his own self-directed IRA. So when he submits the contract, it's going to show two buyers. It's going to show, let's say his name's John Smith. John Smith as to 50% interest, and Midland Trust Company as custodian for benefit of John Smith IRA number 1234 as to 50% interest. Okay. And then closing instructions are going to be sent to the title company or the attorney handling the closing, basically advising them of how title is to be taken and who's going to be signing the documents on behalf of the exchange and on behalf of the IRA. Next slide. So at closing, John is going to sign all the closing documents on behalf of his personal 50% interest in the purchase. Okay, so that's on behalf of the exchange. Midland Trust will sign all documents after John approves on behalf of the IRA's 50% interest in the purchase. Brenda, I think this is the other slide. So the deed itself is going to, is actually going to show both the individual as 50% interest, and it's going to show Midland Trust Company as 50% interest for the benefit of his IRA. So moving forward, what would happen is the expenses and the rents are going to be collected and paid out pro rata, 50-50. So he could have it set up to where there's a property manager to collect the income and then allocate the rents accordingly. Or he could have it set up to where he has the tenant cut two checks, one to him personally on behalf of his 50% interest, and then cut another check to the IRA for its share of the income in the property, or for its share of the rent in the property. Same thing with expenses. We'll have to make sure that the expenses are paid out accordingly. John would have to pay any expenses associated with the property according to his 50% interest. The IRA would be responsible for paying its share of the expenses at closing. So let's say they hold the property for a couple of years and then decide to sell it down the road. What'll happen is John will have the opportunity to either do another 1031 exchange on his personal interest in the property, and then the IRA's portion of the sale is already tax sheltered because it's in an IRA account already. So when the sale closes, the IRA's portion of the proceeds will come back into the retirement account and basically sit there until it's time to do another investment. If John elects to do a 1031 exchange on his personal interest in the property, he's free to do so. His personal interest, he would assign his personal interest in the contract to a qualified intermediary, hopefully Midland. And then at closing, the proceeds from his personal interest of that sale would come to Midland 1031 as QI. And basically he starts that whole process over again with respect to finding another replacement property to roll those funds into. He would not have to partner up with the IRA again moving forward, unless he wanted to. If he liked it and he thought, you know what, this is great, I can continue to buy significantly higher valued properties in the exchange and also help build up some wealth in my retirement account, great, he can totally do that, but he doesn't have to. Or perhaps maybe the next time around, if he doesn't want to use his IRA, but he wants to use Brenda's IRA money, he could partner up with Brenda's IRA on a more expensive property and then repeat the process. So it's important to know that this is an option, number one, because right now in particular, there are clients that really don't like the idea of having to get a mortgage or getting more debt on the new purchase, the one thing I would caution you all on is make sure that you keep in mind the IRA is a completely separate buyer from you individually. So, to give you an example, if you sell for $250,000 and you're doing an exchange and you want to buy another $250,000 property through the exchange, but you want your IRA to fund 50% of that purchase because you don't want to get another mortgage, that's not going to really work for you because the IRA's interest in the purchase will not count towards your exchange. So really, you'd have to be looking at higher value property from what you're selling and having the IRA basically come in with the difference in purchase price. So keep that in mind. The other thing to keep in mind is the fact that some of you who are familiar with 1031 exchanges know that there's a little bit of flexibility with respect to engaging with related parties in terms of renting the property out to them or having some personal use of the property, and eventually having the option of converting that property to a personal residence. IRA rules will prevail in this situation. And as Brenda mentioned, there's absolutely no personal use whatsoever on behalf of the IRA owner or anyone that's considered a disqualified party. So even though the IRA is buying this property with the taxpayer as, tenants in common, and even though part of that purchase was acquired as part of the exchange, it doesn't matter. Those 1031 allowances go out the window if you have your IRA involved in the new purchase in any capacity, even if it is a small percentage that the IRA owns. That's it. You've got to follow the IRA rules. So something to keep in mind, because you want to know going into it what you're allowed to do and what you are not allowed to do. If you want the opportunity to convert that property to a personal residence, then you certainly don't want to get your own IRA involved in this, or anyone that's a disqualified party. So keep that in mind. But if these are truly going to be investment properties that you have no interest or desire in using at any point in time, think about that. Think about incorporating somebody's self-directed IRA or IRAs. I mean, you can have as many people as you want buying the new property with you. Just make sure that you're all buying as to percentage interests and not forming a separate entity to take title. So that's another thing that comes up. Sometimes people will say, oh gosh, I don't want to have to get a property manager. It seems really cumbersome to try to split up the income and expenses for personal and IRA. Can't we just set up some sort of LLC or something to take title to the new property? No, because for a 1031 exchange, we have to make sure that you maintain continuity of taxpayer from beginning to end of the process. So if you were looking to bring someone else in on the new purchase, and you then were thinking, God, it would be so much easier if we could just set up an LLC, I hear you, but you could be jeopardizing your 1031 exchange, because now you're basically creating a completely separate taxpayer that would be taking title to the new property, and it would negatively impact your exchange. So what you want to have is make sure the taxpayer completing the exchange takes title to the new property as to a percentage interest. Don't go forming a new entity to take title to the new property. But I mean, this is just something that we wanted to share with everyone to kind of give you an idea that it is possible for the two to come together. We always try and present them as separate strategies, and usually they are, but you're going to want to just keep in mind it's possible for the two to come together and utilize those strategies to your benefit. Particularly, again, this most often comes up when people don't want to have to get additional debt to, or more debt to buy the new replacement property, because they're looking at something more expensive. They don't want to take out a mortgage. So they're trying to think outside the box and figure out how can we do this without having to get debt. So Brenda, I think I'm going to pass it back to you. I think I covered everything that we were going to discuss.
Okay. All right. Okay. So, are we just gonna get right to the question and answers then,
I
T?
think we can. I
Okay.
think we can. So I can see Rick had a question.
Yes, it looks like Teresa. I'll read them to you.
Okay, cool.
Are DST investments a popular choice to add the three property identification as a failsafe?
So it's not too popular. I would say probably about 10% of our clients probably utilize that as a fail-safe option. And that's exactly the case. Is, they are nervous that whatever properties they're looking at may or may not come to fruition. So they want to have that third option there just to have it as a backup. So, but again, like I said, it's probably about 10% of our clients. Now, that could be, it could be a number of reasons why. It could be that they're just not aware that that's an option for them, or it's just not something they're looking to invest in. So it's probably a combination of the two.
Okay. If I currently own an investment property, can I roll it into a 1031 exchange now, or does this happen once I sell it?
Oh, great question. So, right. So you wouldn't start the exchange process until you're actually under contract to sell that investment property. So there's nothing you need to do at this point in time to designate it as a potential 1031 property in the future. It's simply make sure it truly is investment. You're renting it out. It's not a second home or primary residence, because those are excluded too. But yeah, there's really nothing that you need to do at this point. Just make sure you set up the exchange prior to closing on the sale of that investment property.
All right. So this one looks like it would be for me. I currently own land through my IRA, but considering building a house on the property to rent out as VRBO. I don't have enough in the IRA to pay for the house. How can I fund the down payment? How does the loan work? Okay. So if you don't have enough money in your IRA to fund the purchase, IRAs can take on a non-recourse loan. So basically, the property is used as collateral and there's no personal guarantee on those loans. We do have a list of non recourse lenders that we've worked with that do it, but that is a possibility. And then in order to do it via VRBO or Airbnb, you would need to set up a LLC to do this. Well, that would be the easiest way to do it. Um, and then, yeah, that's that. So, all right. So what happens if I have a loan on the property that I am selling and I want to put it in a 1031 exchange?
Okay, so that loan would have to be paid off prior to transferring that property to the new buyer, but you do need to replace that debt on the new replacement property, either with cash or you can get more debt. It will get a little tricky if you are trying to combine an IRA in the mix, because it's very difficult, if not impossible. Brenda, correct me if I'm wrong, when you've got split ownership and you're trying to get financing with an IRA involved.
Hmm.
If an IRA is the sole buyer, it can get non-recourse financing. But when you have the split ownership where it's part personal and part IRA, it's probably not going to work. I'll be honest, it's probably not going to work. So in that scenario, the debt would be paid off at closing for the sale. And hopefully the client would have access to cash to replace that debt on the new purchase.
All right. How do you complete the annual fair market value form when there is less than 100% IRA owner, an IRA owner, and a non-IRA owner? Do you know this one, Teresa? Or do you want to take
Well, I
this
would
one? Or
think, well, no,
you
I
would
mean, I
still,
think
it's still going to ask for the overall value of the real estate, and I would still assume you would still
wouldn't you do it pro rata though, according to the
to
percentage?
percent ownership. Yes, you're still going to need the proper documentation to show that. So I can find out more information on that for you, Rick. Okay. So Teresa, don't you have to keep equal or greater debt on the replacement property to avoid boot? If
Yes.
I use my IRA to replace the property on the relinquished property, wouldn't that be a taxable event?
So you wouldn't be using the IRA to replace the debt. Your IRA would be an additional buyer on a more expensive property. So you do have to replace the debt on the relinquished property, but you do not have to get more debt. You could replace that amount with cash if you happen to have access to that amount of money in personal cash. So the IRA is not coming in to replace that debt amount. The IRA is coming in to help you buy a more expensive property, if that makes sense. I hope. Rick, I'm sure Rick will tell us if was
I'm
that Rick
sure
that
Rick
asked?
will tell us, yes.
Okay.
Okay, another one. Can a 1031 exchange be used when an investment property it is sold using seller financing to defer capital gains? What will happen in case of an early payoff?
So if okay.
So this question is in the questions box if you want to reread it.
I, I, yeah. Well, so we may need to talk offline about this. When you're incorporating seller financing and a 1031 exchange, it gets tricky because you need to you have to make a decision. You can either have the seller finance portion excluded from the exchange and you get taxed on that amount as payments are received, or if you want it included as part of the exchange, then that finance portion needs to be paid off somehow before closing on the replacement property. So that gives you maximum 6 months to get that seller finance portion paid off. Or you can provide the funds for that portion personally. But the objective is the 1031 exchange should have 100% of the sale amount in escrow to then apply to the replacement property. When you incorporate seller financing, you're basically minimizing the amount of proceeds that are coming into the exchange. So I'm happy to talk to whoever is asking this question because it's a little more involved than that. And I'm sorry if I didn't give a great answer. There's a way to incorporate it into a 1031 exchange, but you may not like the requirements in order to make that happen. Early payoff, yeah, that would be, if you're trying to include it in the exchange, it would have to be paid off in a very short period of time somehow. You'd have to convert that note to cash. So you could either sell that note to somebody else, you could buy that note from the exchange, or like I said, you could do the seller finance portion outside of the exchange. But I'm happy to talk about that more offline.
All right. I'm new at this. What does DST mean?
Delaware Statutory Trust. It is it's almost like forgive me for using this comparison. It's almost like a tenancy in common investment or a REIT, although a REIT is not eligible for 1031 exchanges, whereas DST investments are structured in such a way that clients could actually invest in them as part of their exchange. So you're basically getting a fractional or percentage ownership in a much larger portfolio of properties, or sometimes it's one property. It's just a very high value property that's got multiple owners involved.
All right. Okay. Does anyone have any more questions? I see, Chris, I'm going to get back to you offline. I see your question. Um, does anyone have any other questions while we're live? Otherwise, I'm going to put mine and Teresa's contact information back up on the screen. Second. Okay. All right. Okay, so if you have any more questions, you can contact either Teresa or myself. Here's our phone number and our emails. I'm also going to send a follow-up email. So if you have any questions, you can also just respond to that. But otherwise, that concludes our presentation for today. Teresa, thank you so much for joining us and doing this. Oh,
Yep.
sorry. We have one more come
There's
in.
one more question.
Okay, do you have to replenish the full amount of the IRA that you used? Say the property value went down. No, your IRA is basically just a cash account. Once you put the money in there, it sits in a cash account, and then you can use that money to do whatever you want with it. And then the money goes back in the account, whether you lost money or made money, and then you can reinvest it into something else. You don't have to bring the account value back up. It looks like two more people are typing. Oh, okay. Well, you're welcome all for the presentation. Thank you, Teresa. Thank you. Have a great rest of your week, everybody.